It's March 2023. A bank in California, founded in the 1980s, trusted by half of America's tech startups, collapses in 48 hours. Not because someone stole the money, not because of fraud. It collapsed because enough people asked for their money back at the same time. That's it. That's the whole story. And here's the part that should bother you. The bank wasn't reckless by old standards. It held U.S. government bonds, the safest asset on earth, according to every textbook ever written. It still wasn't enough, because the money you think is sitting in your account, waiting for you, quietly, patiently, isn't. It hasn't been there for a long time, and the moment enough people remember that fact at the same time, the whole system shows its hand. This is the story of how banking actually works, not the version on the brochure, the real one. You'd think after 2008, after the bailouts, after Congress holding up charts in front of cameras, the system would have changed. It did. A little. Banks now hold more capital than before. Regulators run stress tests. There are more rules than ever. And yet, in 2023, 3 banks failed in the span of 2 months. Combined, they were larger than every bank that failed in 2008. Larger. Not because banking got more dangerous, because banking never stopped being dangerous. We just got better at not noticing. This isn't a story about villains. No one in this story is twirling a mustache. It's a story about a system that works fine until the one day it doesn't, and that one day always arrives faster than anyone expects. Here's the part they don't explain well, mostly because it sounds insane once you say it plainly. You deposit $1,000. The bank doesn't put it in a vault with your name on it. It lends most of it out. Maybe $900 goes to someone buying a car or a business expanding, or another bank borrowing overnight. The bank keeps a small fraction on hand. Historically, around 10%. After 2020, in the United States, that requirement was actually dropped to 0. 0. Banks are not legally required to keep any fixed percentage of your deposit sitting there waiting for you. This isn't a glitch. It's the business model. It's called fractional reserve banking, and it's been the foundation of modern finance for over 300 years. The logic is simple. Not everyone withdraws their money on the same day. So the bank lends most of it out, earns interest on those loans, pays you a sliver of that interest back, and pockets the difference. It works beautifully, as long as you don't all show up at once. Here's where it gets uncomfortable. If every depositor at almost any bank on earth demanded their full balance in cash tomorrow morning, the bank could not pay everyone. Not because it's broke, because the money was never sitting still. It's out in the world, tied up in mortgages, business loans, car payments, bonds that mature next year, not next hour. This is called a bank run, and it's not a rare historical curiosity from black and white footage of the 1930s. It happened in Silicon Valley Bank in 2023. $42 billion left in a single day. Not a single week. A single day. Triggered partly by panicked phone calls, but mostly by something far more modern, a group chat. Venture capitalists in private Slack channels and group texts telling each other to pull their money. No mob outside the building. No newspapers. Just notifications. The bank run of the 21st century doesn't look like a line outside a building. It looks like silence, followed by a number on a screen dropping to 0. And here's the irony nobody likes to sit with. The faster and more convenient banking becomes, the faster a bank run can happen. We built apps that let you move your life savings in 4 taps. We just didn't build a banking system designed to survive that speed. The marketing version of your bank account is reassuring, FDIC insured. Your money is safe, sleep easy. And to be fair, that insurance is real. It has protected depositors for decades, and for amounts under the insured limit, it generally works exactly as promised. But notice the careful wording. Insured up to a certain amount. per depositor per bank. Above that line, you're not a customer anymore. You're a creditor, standing in a line, hoping the bank has enough left over after the bigger creditors get paid first. Most people never read that far into the terms. Why would they? It's not exactly marketed on the homepage. The reality is this: banking isn't a vault. It's a confidence machine. The entire system runs on a shared agreement, not to all ask for the truth simultaneously. It's a magic trick where everyone in the audience has agreed, silently, never to check if the rabbit is actually in the hat. Now stretch this further, because deposits are just the beginning. Banks don't just lend out deposits. They borrow against assets, package those loans into bonds, sell pieces of debt to other institutions, who then lend against those same pieces again. Money in the modern economy isn't a fixed pile sitting in vaults. It's closer to a number that gets counted multiple times across multiple balance sheets, all relying on the same underlying promise. Economists have a polite term for this: money multiplier effect. A less polite way to say it: there's more money circulating in the system on paper than physically exists anywhere. This isn't a conspiracy. It isn't hidden. It's published in central bank reports, openly discussed in economics departments, taught in finance courses around the world. It's just rarely said out loud in plain English, to regular people, the way we're saying it right now. And once you see it, you start noticing it everywhere. Why central banks watch interest rates so obsessively. Why a regional bank failure in California can spook markets in Singapore by the next morning. Why governments respond to bank failures within hours, not weeks, the way they respond to almost nothing else. Because the entire system isn't built on gold or cash or vaults. It's built on timing. As long as withdrawals stay slower than the system can handle, everything functions. The moment the timing breaks, even briefly, even at one institution, the cracks don't stay contained. They spread because every bank is quietly connected to every other bank through loans, bonds, and overnight lending that never sleeps. Here is the part that should sit with you a little longer than the rest. We've built an entire global economy on a system that functions perfectly, right up until human psychology gets involved. Markets don't crash because the math suddenly stops working. They crash because people all at once stop believing the math will keep working. And belief, unlike capital reserves, can't be regulated. You can mandate stress tests. You can raise capital requirements. You can write thousands of pages of banking law. You cannot mandate calm. So, we're left with a strange arrangement. A financial system trusted with literally everyone's life savings, built on logic that only holds as long as nobody examines it too closely. All at once, in the same moment. Most days, nobody does. Most days, the system works exactly as advertised. But every few years, somewhere in the world, a different group of people remembers the same uncomfortable fact at the same time. And for 48 hours, the whole illusion becomes very, very visible. So here's the question worth sitting with. Long after this video ends, if the money in your account was never really sitting there waiting for you, what exactly are you trusting every single day without ever checking?